Met Coal Junkie, Weekly Wrap, June 16, 2025. Welcome to this week's edition of the Met Coal Junkie Weekly Wrap, where we track sentiment, supply, and the pulse of the global coking coal market. This past week has underscored the market's growing fragility. Price action is softening, but buyers are staying away. Let's walk through the developments in one continuous story. The Oaky North offer, which had fallen to $175 FOB by the end of last week, resurfaced this week at $170 a FOB. But even at this lower level, the market refused to engage. No firm bids emerged, and the offer remained untouched, an unmistakable signal that sentiment is not just weak, but deteriorating. While sellers are showing their hand, buyers are deliberately sitting on theirs. Meanwhile, BHP sold its GYC cargo at 180.9 FOB for an end July laycan. This was a key trade many had been watching, yet once it cleared, it failed to spark any upside. Traders took the deal in stride, and the lack of a bullish reaction reinforced how jaded the market has become. What might have once been a trigger for renewed optimism instead confirmed the weight of existing supply. On the paper side, TSI June paper slipped from $183 to $181 last week, and July from $179 to $178. This week, Q3 paper briefly touched $178 again, but quickly fell below $177 after the GYC print. The initial rebound faded almost instantly. There is simply no follow-through. Liquidity remains thin, and conviction is absent. The PLV-PMV gap continued to widen. Branded PMV is holding its levels for now, but PLV-linked supply is piling up, including the Oaky cargo and Southeast Asian mill resales. With more PLV flooding the spot market and dragging the index lower, this divergence is looking increasingly unstable. The market cannot sustain a two-tiered pricing system for long if PLV keeps weighing down the benchmarks. In China, the domestic tone worsened. Last week saw a third round of coke price cuts. This week, a fourth was announced, and expectations for lower Q3 long-term contract pricing are now widespread. The weakness in domestic pricing is bleeding into the seaborne market, eroding support for resellers and making any sort of FOB rebound unlikely. Southeast Asian and JKT buyers, who were at least sniffing around the $170 FOB level last week, have now gone quiet. No confirmed spot trades for HCC or PHCC were reported this week, even as bid-offer spreads widened further. Inquiries are still happening, but no one is pulling the trigger. The market is paralyzed, watching, not acting. And while mine recovery signs were discussed in satellite reports last week, attention has shifted to the real cargoes now entering the spot market. Oaky North is officially in play, BHP's GYC has cleared, and sea mill resales are gathering. The resell story isn't speculative anymore, it's tangible, and the market is struggling to absorb it. All of this culminates in a tone that feels unmistakably heavy. Last week's bearish turn has become this week's confirmation of oversupply. Confidence is fading. Buyers aren't motivated by lower prices. The market feels like it's waiting for someone else to move first, but no one wants to take the risk. Looking ahead, next week will be pivotal. If Oaky North clears or a new GYC offer emerges and trades, it could help establish a floor. But if the silence continues and more cargoes pile up unsold, the market could slip further. Sentiment is fragile, and all it takes is one more missed trade to tip it downward again. That's the full wrap for the week of June 16th to 20. Stay tuned, stay sharp, and remember, in this market, even no trade is a loud signal.